When a firm like Morgan Stanley publishes a roadmap for 2026, they are not making a casual forecast. They are positioning capital. They are signaling where institutional money expects earnings durability and where risk is being quietly offloaded. It is about what works in a world where inflation is sticky, capital is scarce, and AI is restructuring balance sheet, not just business models. So Morgan Stanley is effectively saying this. It is saying that yes, the bull market can continue. That is, yes, that's what's going to happen. But it's also saying the following. Yes, the S&P could reach 7,800 to 9,000, but only if you are positioning correctly. And most investors are not. Today we are going to break down, one, why this call matters. Two, what Morgan Stanley is really saying beneath the surface. Three, which stocks benefit from the macro regime. Four, which sectors look safe and why safe is misleading. And most importantly, what they are quietly telling you to avoid. That is very important. Morgan Stanley's base case of 7,800 and bull case of 9,000 for the S&P 500 is not optimism. It is conditional confidence. This outlook assumes, one, no systemic credit accident, no hard landing, and continued earnings resilience driven by AI-linked capital spending. But here's the key point most people miss. This is not a broad-based rally call. This is not a quality concentrated, balance sheet driven, cash flow dominant market thesis. This is not 2021. This is not liquidity driven. This is not meme stock friendly. This is an environment where, one, the cost of capital matters. Two, guidance credibility matters. Three, and survival bias becomes performance. That is why the preferred style is large cap quality, not growth at any price, not speculative beta, but companies that can self-fund expansion, right? So let's talk about the headline names that I mentioned in this report. First one, obviously, is Amazon. Then you have NVIDIA. Then you have Astera Labs. Then you have the NASDAQ. Then you have APN and JFrog. On the surface, they look unrelated. But structurally, they share the three traits. One, they sit upstream of demand. These companies don't need consumer optimism. They benefit from enterprise and infrastructure spending. Two, they monetize inevitability. Cloud, AI compute, data flows, software tooling, market infrastructure. Three, they scale without balance sheet fragility. No dependency on cheap refinancing, no reliance on speculative demand, no margin illusion. This is defensive offense. Right? So let's talk about, all of them. First one, let's talk about Amazon. Amazon isn't here because of retail. It's here because AWS is an AI utility. Amazon is cornering the market literally on cloud computing. AI workloads do not run on hope. They run on compute. They run on storage. They run on infrastructures. Right? And AWS is embedded into enterprise AI, government AI, defensive AI, healthcare AI. Amazon benefits regardless of who wins the AI application layer. They sell the picks, they sell the shovel, they sell the electricity. Number two, NVIDIA, right? Everybody heard about NVIDIA. It's not only an early stage anymore, but it is early in monetization duration. You know, this is where you can't really say that we're going to have an AI bubble, because these are real companies. The key word is CapEx boom. Data centers are not optional anymore. They are strategic assets. And NVIDIA sits at the center of training, inference, networking, software lock-in. This is not about unit sale. This is about platform dependency. Astera Labs, right? Astera Labs is quietly one of the most important names on this list. Why? Because AI doesn't scale on GPU alone. It scales on connectivity, bandwidth, latency, signal integrity. Astera lives inside the plumbing of AI infrastructure. This is the classic institutional move. Less headline risk, less valuation hype, massive structural tailwind. Okay. NASDAQ. Right? This one is subtle but brilliant, right? Morgan Stanley isn't just bullish on stock. They are bullish on market activity, volatility, listing, derivatives, data monetization. And the NASDAQ benefits whether markets go up, down, sideways, or how long as the participation rises. APN and JFrog. They are execution bets, right? Not moonshots, not story stocks. They are positioned to meet guidance, beat modest expectation, and survive margin pressure. In this market, boring execution is alpha. Then, of course, you have the software safe list, right? Read the word carefully. Morgan Stanley called this the safe list. But safe does not mean upside explosive. It means achievable estimates, realistic guidance, and survivable growth. Palantir, Snowflake, Akamai. These are the second AI beneficiaries. They monetize data orchestration, security, infrastructure optimization. It's not a hype, it's not a narrative, it's usage. And notice what's missing. No unprofitable SaaS darlings, no speculative revenue multiples, no AI buzzwords without cash flows. Also notice the cautionary flag, Datadog, PagerDuty. Why? Because guidance risk kills multiples in this environment. That means because the multiples are so high, you cannot afford a mistake. So what are the themes for 2026? Well, that's the real message here. Well, first of all, this is the document, gets honest. 1, AI infrastructure and real assets. This is not about software margins. This is about power, energy, grids, and pipelines. AI is energy intensive, and energy inflation is structural. Morgan Stanley is telling you the following. If you want inflation protection, own real assets. Why do you think gold, silver is going up? Utilities, energy infrastructure, grid modernization. This is the unsexy backbone of AI. Cyclical recovery and deregulation. This is a political overlay, right? Financials, the capital markets, traditional energy. If regulation loosens, margins expand. This is not ideological. This is mechanical. Banks don't need growth. They need spread stability and regulatory relief. Then you have healthcare revival. Healthcare has underperformed. Why? Well, that's exactly why it's here. Positive earnings revision, AI-driven efficiency, demographic inevitability, big pharma, life science, medtech. This is a late cycle allocation. Right? So what to avoid? And that's critical. Morgan Stanley is crystal clear here. Avoid long duration bond, high consumer exposure. Why? Well, because inflation risk is not gone, because refinancing risk is real, and because consumer balance sheets are weakening. This is not 2010. This is not Q infinity. This is duration is fragile. Consumption is vulnerable. So final warning, this document is not bullish. It is selective. It is telling you concentration beats diversification. Quality beats speculation. Cash flow beats narratives. That is what it's doing. And you need to be aware of that because this is important, right? What it's telling you is that the cash flow beats narratives. The bull market doesn't lift all boats anymore. It rewards discipline, it punishes leverage, and exposes weak guidance. If you ignore that, the market will teach you. Next, let's talk about stock market cycles, because this is very important for you to understand. It's very important to understand because it looks at 60 years of stock market cycles. And let's start with a simple question. If the stock market is such a guaranteed wealth building machine, why does it repeatedly destroy investors every single decade? This chart shows 60 years of stock market history. Bull market is in blue. The bull markets are in blue, as you can see, and the bear market's in orange. Recession shaded in gray. And what it reveals is uncomfortable. Because the biggest mistake investors make isn't picking the wrong stock, is you're misunderstanding the cycles. Markets don't move in straight lines. They move in violent expansions and brutal contractions. And most people only remember the expansions. And that's a mistake that most investors make. So, the lie about buy and hold forever. Look closely at this chart. Bull market feel permanent. You could see that. But bear markets feels impossible until they happen. From 1962 onward, the S&P experienced multiple bull markets exceeding 100% returns. Some were explosive, 228%, 400%, even 582% during the tech and internet boom. And every single one of them ended the same way, with a drawdown. Buy and hold works only if you survive the drawdowns emotionally and financially. Most investors don't. They buy late, they panic early, they sell at the bottom. That's why I always tell to my investors and my Patreon members, make sure that you buy when everybody else is selling and sell when everybody else is buying. Cycles aren't optional. They are the market. So bull markets, they are long, they're seductive, they are dangerous. Let's talk about bull markets. On average, we're talking 151% total return, 51 months of duration. That is huge. That is not a small amount, right? That's long enough to build confidence, forget risk, convince yourself this time it's different. Every bull market creates its own story. Remember, productivity gain, financial innovation, new paradigm, AI changes everything. Rate will never rise again, and the longer the bull lasts, the more leverage and speculation creep in. But markets don't die of old age. They die from excess. So let's look at the orange a little bit, because that's when it hurts, right? These are the bear markets. Average decline minus 34%. So be ready to lose 34%. And the duration on average is 11 months at 3 weeks. So that's the key. Bear markets are fast. They undo years of gain in months. Minus 48%, minus 52%, minus 36%, minus 30%. And the psychological damage is worse than the financial damage, because people don't expect them. They come when valuations are extreme, leverage is hidden, confidence is absolute. Bear markets expose what bull markets hide. And that is tough, because recession are not the cause. Do not tie the fact that you're expecting a recession with a bear market. As you could see, look. Right? You see the orange always tied to a recession? That's not always the case. Notice something important. Recessions are shade in gray, right? But markets often peak before recession, bottom before the recession ends. The market is not reacting to today's data. It is repricing future expectation. The market is basically always doing price discovery ahead of you. The question is, how far ahead? That is why strong economic data near peaks is a warning. Strong economic data, we kind of right now, weak data near bottom is an opportunity. Most investors get it backwards. They buy when the economy looks strong, which you shouldn't. You should get out. And they sell when the economy looks weak. Again, I tell, and please join my Patreon channel and also subscribe and give me some thumbs up to help support this channel. And the idea is to understand that you need to buy when everybody else is selling and sell when everybody else is buying. That's very important. Look at let's take a look. Let's take a look at the longest bull market ever. Look at the late 1990s. The chart itself even labeled it the longest bull market in history. 582% total return. Right? Driven by tech optimism, internet adoption, easy liquidity. Sound familiar? It ended with a valuation reset, a confidence collapse, and a lost decade for money investors. Innovation doesn't eliminate cycles, it amplifies them. So 2008, and I remember that one, when leverage snapped. Now look at the worst drawdown, 51.9%. That cause wasn't housing alone. It was excess leverage, financial engineering. It was mispriced risks, belief that diversification eliminated the danger. Every crisis looks unique. Every crisis is structurally similar. Leverage plus complacency equals collapse. Remember that. The most important statistic on the chart, here's a stat that matters most. Bull markets last 5 times longer than bear markets. But those bear markets destroy wealth 5 times faster. That asymmetry is everything. Risk management isn't about predicting tops. It's about surviving the drawdown so you can compound again. And that's what this channel is about. This channel is called the Black Swan because we're looking for risks in the market for your benefit. So don't forget to give me some thumbs up and to subscribe. The investors, you have to survive the drawdown so you can compound again. The investor who avoids catastrophic loss beats the investor who chases maximal return every time. When you're crossing the street, what your goal should be is to make sure you don't get run over. That's number one goal. Because if you get run over, you can't get across the street. So the chart doesn't tell you tomorrow's price. It tells you something more valuable. I'm not here to tell you whose stock is going to go up or down. I'm telling you, be careful. It tells you what always happens, what never changes, and what investors refuse to learn. Cycles compress. Cycles expand. Cycles repeat. Your job is not to outsmart the market. Your job is to respect the cycle. Because markets don't care how confident you feel at the top. And they don't reward panic at the bottom. So final warning. Every bull market convinces people risk is gone. Every bear market reminds them that risk was always there. If you understand this chart, you understand more than most market participants ever will. See what I mean? Look at the chart. Okay. Take a look at the chart in great detail. This is a fantastic because it shows you a lot of important information. Right? Take a look, for example, at let's think about look at 2008, right? Minus 51%. Don't forget, to get back that, you got to double that money, plus the money that you lost that you could have made. A historic rise in housing prices fueled by subprime, its worth crashed since the Great Depression. Right? 51%. Great Depression, as you could see, you go back to, I don't think we go back that far, but you had 48%. Now look at the average duration. Look at the blue dots. See the average duration? Right? The average duration is 51 months. The average duration of a bear market is 11 months. So be ready. When it starts, it will last at least a year. Are you ready for that? Right? We made 500%. Right? That was the famous 2000. But remember, when the market collapses, look at the gray line. Right? If you look at the gray line, you're going to see all of the recession. You see the recession? The last one that we were was in 2000. Frankly, in the real recession, was in 2008. And frankly, it hits after the peak, right? We had a bit of a down. You could see minus 27% and minus, well, it was a double whammy. We now have 51% and 21%. But they don't necessarily match every single time. I mean, you had a recession in the 90s and the stock kept on going up. I had market went up after 2000, right? But there was no recession. And it collapsed not always because of a recession. Sometimes it collapsed. Look at the date. The collapse of that little mountain when it drops doesn't coincide with the gray line right against it. That's because it's all about timing. It's all about understanding what you're trying to do. It's all about realizing that it's all about buying alone and selling alone. Buying when everybody else is selling and selling when everybody else is buying. That is a very important principle that needs to be understood by all my investors and all my subscribers, which I want you to be subscribing. I want you to give me some thumbs up to understand that you understand what's going on in the stock market. I'm all about making sure you cross the street. That's what I do most of the time. And by crossing the street, making sure you don't get run over, obviously. That is key. So let's take a look now. What about the other time? What did that look like? When things start collapsing all over. Right? Give me a second here. What am I missing? Let's take a look at this one. This is a doozy right there. Look at this. This one shows you very interestingly all the other bubbles. What did they all do at that time? So let's take a look at our third one. Let me show you something that humiliates almost every investor, every strategist, every talking head on financial television. This chart is not about valuation models. It's not about earnings projection. It's not about soft landing and narratives. It's about human behavior. And that you need to understand human behavior if you want to make money in the stock market or anywhere for that matter. Every single spike you see represents the same psychological sequence. Disbelief, excitement, justification, leverage, euphoria, collapse. Different decades, different assets, same ending. Gold in the late 70s, believe it or not. Japan in the late 90s. Asia in the 90s, the internet in 2000, housing in 2006, China in 2007, biotech in 2015, FANG in 2021, ARK, AI, Bitcoin. The names change, the story never does. And if you think this time is different, this chart was made for you. Look at it. Bubbles do not form because people are stupid. Here's the first mistake people make, right? They assume that bubbles are driven by stupidity. They're not. Bubbles are driven by intelligence under social pressure. Every bubble starts with the truth. Gold in the 70s, inflation was real. Japan in the 1980s, export dominance was real. The internet, the technology was real. Housing in the 2000s, demographics and credit expansion were real. Bitcoin, digital scarcity and distrust in fiat currency was real. What about AI? Productivity gains are real. The problem is never the starting insight. The problem is extrapolation without limits. When price appreciation becomes the proof, logic dies. Why every bubble looks different but ends the same? Notice something critical on this chart. Every bubble has a unique shape, but every collapse has the same emotional profile. First, price acceleration. It accelerates faster than fundamentals. Then valuation metrics are declared obsolete. Then skeptics are ridiculed. Then leverage appears prudent. Then volatility disappears and the peak arrives suddenly, and then comes the air pocket. No bell rings at the top. The top is not an event, it's a process. By the time CNBC debates whether something is a bubble, the exit liquidity is already being engineered. Okay. Forget to give me a few thumbs up, a few more thumbs up. Forget to join this channel to support it. And more importantly, join the Patreon channel where I come to you every day, take all that knowledge that I'm acquiring and giving it to you, right? So let's look at the gold in the late 70s, right? Don't forget, it went up and it went down. Inflation, oil shock, geopolitical stress, Gold doesn't just rise, it exploded. And then Paul Volcker happened. Now, Paul Volcker, as you may remember, was the Fed chair. In 70, he crushed inflation. So rates went up, crushed inflation, and gold spent decades going nowhere. Be careful, because if you were to look at what's happening to inflation right now, it is mimicking very strongly what happened in the 70s and 80s with Paul Volcker, where Nixon basically wanted to lower rates as much as possible, even though there was inflation. This is exactly what currently the administration is trying to do with the Fed. Now, lower the rates. Let's bring people in that will lower rates, even though there is an inflation concern. Is there an inflation concern? There potentially is an inflation concern, because if you look at the Treasury rate, you will notice that it is above the Fed fund rates, and it's never like that. That means the market, the treasury market believes in inflation and says, I want to get paid more to hold treasuries because there's inflation hidden. Even though the Fed says, don't worry about inflation, worries about unemployment. So that was not stupidity in 1989. The Imperial Palace in Tokyo was worth more than all real estate in California. That was not stupidity. That was collective certainty. Japan was the future until it wasn't. And Japanese equities are still recovering 35 years later. Bubbles don't destroy capital, they destroy time. Let's take a look at the internet bubble, where narratives replace cash flow. The internet bubble is the most dangerous one to misunderstand, because the internet actually changed the world. Amazon survived, Google thrived, but investors did not own the future. They overpaid for it. 90% of dot-com stocks were never recovered. They never recovered. And innovation does not protect you from valuation. Being right too early is indistinguishable from being wrong. What about the housing and the lie of the nationwide price stability? Housing was sold as a safe, right? Low volatility, stable appreciation. Everyone needs a place to live. Remember that? That narrative justified leverage, extreme leverage. And when housing fell just a little, the entire financial system cracked. Because bubbles do not burst due to falling prices. They burst because leverage meets volatility. These are important concepts that you need to realize. The modern era, right? FANG, ARK, AI, Bitcoin, they are not identical assets, but they share the same structural accelerant. Cheap money, passive flows, narrative investing, social media reinforcement, algorithmic momentum. Bitcoin dwarfs every historical bubble on this chart. That does not make it immune, it makes it fragile. When volatility rises, the marginal buyer disappears. And when the marginal buyer disappears, price collapses faster than it rose. Why AI is the most dangerous bubble yet? Well, AI may be revolutionary, but revolutions do not guarantee returns. Capital floods innovation, margins compress, competition accelerates, valuation assumes perfection, and perfection never arrives. The biggest mistake investors make is confusing technological inevitability with investment inevitability. That is not the same thing. So to end, in conclusion, this chart is not bearish. It is educational. Every bubble teaches the same lesson. Returns are highest before consensus forms. Risk is lowest before narratives harden. The exit is smallest when confidence is highest. You're being told something is inevitable. You are being sold. Markets don't end in panic. They end in confidence. And confidence is exactly what this chart warns you against.